Global equities rebounded in March, while global bonds continued their slump, as attention pivoted from Russia-Ukraine to an increasingly hawkish Fed and the start of earnings season beginning in April. While many are focusing on the prospect of 50 basis point rate hikes ahead, more important will be the Fed actions to reduce its balance sheet. We expect this to take center stage entering the summer, as the Fed likely drains $100 billion per month from the system. Remember, when they did a fraction of this in 2017-2018, U.S. 10-year yields rose 100 basis points. So we continue to expect U.S. Treasury yields to probe further into the 2.5% to 3% range in the weeks ahead. As a result, we've continued to take a capital preservation stance in our fixed income portfolios, reducing high yield and emerging market debt in particular. In their place, we've added positions to capitalize on the now inverted U.S. yield curve, while at the same time adding to our existing credit long-short exposure, which has sheltered investors well through this period of rising bond yields year to date. In equities, earnings season in April and May should prove pivotal to the outlook ahead. We're no longer expecting upside risk to earnings expectations, with risk building that downside may manifest itself going to year-end. As a result, investors should focus on first, rotating underlying equity holdings to favor high-quality, high-visibility earnings and dividend streams. This should help shield portfolios against the risk of earnings disappointment, which the January reporting season highlighted as presenting asymmetric risk for equity holders. Pairing this high-quality, high-visibility focus with outright protection via options is especially important given the sharp drop in volatility in March, and should help reset the risk-reward profile that is currently skewed against equity investors. With volatility coming into commodity markets in light of increased intervention by governments to stabilize prices, investors are increasingly facing near-term two-way risk in commodities. However, given the magnitude of investment required to reshape the global energy network alone, we believe investors remain at the early stages of a long-cycle rally in key commodities. For investors seeking to participate in this long-cycle trend, the declines in the energy transition space since early 2021, as well as the lagging commodity-oriented currencies of Australia and Canada, offer attractive risk-reward profiles. For more detail about how we're not only protecting portfolios amidst growing economic uncertainty, but also the opportunities that have emerged as a result, please visit us on ubp.com.